Hey friends, how you doing this evening? This is Brian with Strategic Trading, and we're back once again for part two of our video on our multi-platform insurance system trading. Okay, now where we left off at earlier in our first video, I showed you guys the setup and how we went about placing the trade. Now let's look at what actually happens with the trade. Okay, and you notice it's got to be a special video. I decided to show my handsome face. Okay, so it's got to be good. All right, so what we have going on here, recap. We started with the euro pound pair. Euro pound, we were selling the euro pound at 8,800 for an expiration time of 7 a.m. And we got 10 contracts on that. And those contracts cost a max loss possibility of $820. And the profit on that was going to be 190 bucks. So we're always looking to get about $70, $75 off of that. So we're looking at this case, we're a little bit short on that, okay? But $200, $190, that's good. That's what we're looking for. Now, on the buy side, we have $797 of risk, but that gives us a profit potential of $212. So together, we're looking at around $400, and separately, we're looking at about $800 of risk. So 2 to 1 on that. But that is what we're looking for, because what's going to happen is we're going to get either one or both of these contracts. Now, with strategic trading, what we do is this. If you guys who do not know, we are an insurance agency, all right? And we insure those contracts against loss. 1, 100, 10, 20, it doesn't matter. It's all the same. You pay a premium, like you do for your car insurance or anything else, and we use this premium to insure you against loss. And the way we do that is simply with this. We take the premium that you give us, and we place it in a high leverage Forex account, and we place our trades directly opposite of yours, where you are going to lose money. We make money. We make just as much or a little bit more than you would lose because of leverage. And then we pay you out of that if you need it. And that will leave you at a break even and leave us with a little money as well. And next month we'll do it again. And this makes a profit for us and for you as well. So in this case, you're running 10 contracts. And we would need, in this case, well, actually, it was $2,500, which you have over here. And it was at $2,500, $2,299 of it goes into leverage, goes into a margin, a margin position. And that is a deposit that we give to our broker. And in return, we're able to trade at $130 a pip, and a pip being the smallest measure of movement in a Forex pair. And this is what we use to insure you. So we have 10 contracts on your Nadex, and you see your risk, and you paid us the $2,500 for the month. Okay, and when I say month, I mean 20 trading days. And let me clarify something about this. When we say a month, we don't mean exactly 20 days. We mean 20 trades. So if you miss a day or you miss 2 days or whatever, and you paid us, you can get those whenever you're ready to trade. Those are 20 trades. And that's crucial to remember, because sometimes you can't get to the market or whatever, but you're covered whenever you take those. So here we are again. Say we have our trade going, and you place your 200 and your contracts. You already placed those, and we have coverage for you. So now we come in, and here's the situation that you're looking at. We're looking at price between 8,800 and 8,760. Should price land in that 40 pip zone at 7 a.m., you, the contract holder, will win both of those contracts, or all 20 of them, 10 on top, 10 below, and you will make the full value of around $400. Now, if price is above 8,800 or below 8,760, then you will lose one and win the other. Now, just for if it's not plainly obvious to you, which I'm sure it is, but just in case there's some new guys here and who don't quite get this, there is no way that you can lose both sides of this equation. Price at 7 o'clock cannot be above 8,800 and simultaneously below 8,760. One of these sides of this equation must win. That is crucial in this, because now all we have to do is manage the other side to a neutral position, and you win the other. One must win. Both can win, but both cannot lose. So that is the way that we can guarantee a profit, because you're locked in on one of them. There's no way you can lose them both. So let's go ahead and see what happens now. And so we have set up our insurance trade, and we have set it up in a way that we're going to, if price moves up, we're going to go ahead and knock that out. And if price moves down, we're going to go ahead and get into that position. In this case, price starts to go up, and we enter the trade at 87.79, and at 8,800, okay, 88.01 is where your contract is no good, and we are far from 88.01. We're at 87.79. All right, so now we've actually gone into our trade at 87.79, and we have our margin has kicked in, $2,299, and we are at zero win or loss, but we are in the trade now. We are live. And what has happened next? We go up 1 pip. And you can see we have gotten not even 1 full pip, excuse me. We're going up a fraction of a pip. We're at 87.79.1 is where we entered, at 87.79.2, which is 1/10 of a pip. Okay, we're up $13.10 because the full is $130. So we're up 1/10 of a pip, and that is the increase in value that we have gained. Now, at 87.81, from 79 to 81, we're at $248.71 of insurance of your entire $820 that's at risk, and price goes on. Now here we are at 87.82, and we have $497 of profit, well, of insurance, let's call that, insurance against your risk of $800. Now, what's going on your option side? Well, while this is going on our side, we are covering your insurance. We are covering these contracts for you. What you are looking at on your end is this. Right now, you have 10 contracts, and you're looking at negative $60, and you have a positive $50 on the other. So right now, you're only down $10 on your position if you were to close it out now. But you have 4 hours and 46 minutes left on this trade. And as time decay continues on, you'll see the price variance and how your contracts will gain in value or lose in value depending on which side price is on right now. Okay, and together it looks like this. We have, with 4 hours and 48 minutes left, we have a negative, we have a positive $50 on your insurance, on your option. We have a negative $57 on your options, and we have a insurance gain of $588.52. And it seems like a lot now, but here's the thing. Options have what's called time decay. And as is the same in basketball, if you have the ball and you're winning the game, as the shot clock continues on, the more likelihood is you're going to win the game. The more likely you're going to win because, time is on your side. If in the inverse, the same, if you're losing the game and you don't have the ball, every second that clicks off there means it's one less second that you're going to have to win the game, and the likelihood is you're going to lose. Same way in options, depending on where you are, one side will be winning and one side will be losing, depending on where you are. But you have both sides of this equation. So one side of your contract will be losing in value while the other will be gaining in value. And we have the full value in insurance, because with spot forex, there is no time decay. So this spot forex position represents what your position will be at full value at 4 hours. Okay, it doesn't change over time, but this is what you will be gaining or losing at this time 4 hours from now. So here's a way you can look at this, and you can see the price correlation between the two. Look at the insurance right now with 4 hours and 43 minutes left. We have $431.61 in profit. We have $42 in loss on one of your insurance, on one of your options, excuse me, and $40 in profit on the other side of your insurance. So we have 40, 42, and 430. See how they all lined up together? And if you look over here, we have with 4 hours and 41 minutes left. Now we have, as price moves up, $45 in profit on one side of your equation, $55 in loss on the other side of your equation. There's that $10 variance again, but it's still right there. That's your spread difference. And in insurance, you have $536.23. 530, 55, 45. There is the correlation again. And you'll see this correlation continue all the way through this process. Here's one that's really good. We have 4 hours and 40 minutes. And see how these are just minutes apart? Time is ticking, and these are snapshots, those screenshots that are taken. But as you can see, as time ticks off, every second changes, but the variation stays exactly the same. And why is that there? Okay. The variation stays exactly the same. We have, in this case, $470.87 in insurance, $47.50 in loss, and $40 in profit on the other side. Almost exactly 10% all the way across the board. And this maintains the all the way through. This price variance shows that the correlation between spot forex and between the Nadex options is definitely connected. There is definite correlation between the options time decay and the spot forex rate that we have set up here, which I know because I set that up. Now, the end result is price jumps up, hits our 7 pips that we needed. We entered this trade at 87791, and we have a take profit at 8760 for a complete and total victory, a complete and total win of $902.73. Your complete risk was $820. At this point, it does not matter what happens on these contracts in the next couple of hours. It doesn't matter if one side wins, the other side wins, or both sides wins. Because if you have strategic trading, you win. You will win either both of those contract sides, or we will take $820 out of the $902 that we have just made in profit, and we will reimburse you the full cost of those contracts because you paid the $2,000 that it took to make this. And we will do this again tomorrow night, and tomorrow night, and the night after, and the night after, and the night after. We will do this 20 consecutive times before you have to pay again. Now, anybody with the slightest bit of mathematical skills can see the value in this. If you're listening to me and watching this video right now at this point, you see the value in this. And we are here for you. And I am more than willing to show anyone who wants to know how to participate in this type of trading, just reach out to me. And guys, I want you to know that I thank each and every one of you who is a member of Strategic Trading and those of you who are coming. And for those of you who don't, good luck out there. You guys have a wonderful night. Thank you for listening.